Welcome back. Today, I'm going to be very proud to share with you some amazing things you need to learn as a real estate investor. Most real estate investors, especially rookie investors, the beginners out there, even a lot of so-called savvy investors who have purchased several rental properties in the recent past, even those folks does not fully understand the tremendous value of owning a rental property. People think buying a rental property is all about cash flow, or I buy a $200,000 rental property and it rents for $1,800 per month, whatever, and I put 25% down payment, and I'm only get $200 or $300 monthly net cash flow. That's it. That means this is only like a 3% return on my investment. I could buy a mutual fund, I could buy a stocks, I could buy a money market earning more than 3%. This is such a uneducational narrative that are spreading all over the mainstream media. So, having been in the real estate business for a long, long time myself, for the past 20 something years, uh, uh, and I own a large real estate portfolio over the past few decades, and I coach and mentor and consulted hundreds, if not thousands, of mom and pop real estate investors to buy income property to achieve your wealth building, achieve generational wealth. And yes, they found a foundation of buying a rental property is cash flow, right? You got to have more income than expenses. That's, that's the balance sheet. That's your profit and loss statement, right? The rent you can collect, from a tenant should exceed all the combination of your mortgage debt on the financing, your taxes, insurance, property management fee, vacancy factors, maintenance issues, and all those kind of things. At the end of the day, at the end of the month, at the end of the year, you still have positive cash flow. I get all that. That's the foundation. But once again, I'm going to dive very deep from a very numerical perspective. I'm going to share with you the multi-dimensional aspect of owning a rental property is way beyond cash flow. Okay, it's all about appreciation potential. It's all about tax benefits. It's all about rental rates increases and the tenants paying down your loan, right? And so there are like five dimensional aspect of owning rental property. Is rental property is the greatest realistic asset because it's a multi-dimensional, it's way beyond more than cash flow. So if you understand the illustration, if for the next 15, 20 minutes, whatever, you really pay attention to what I have to say. It may sound a little bit boring, it's a little bit number crunching, but it's not, it's not pure math. This is sixth grade math, all right? So try to understand from a high level, okay? I need to educate you folks out there. If you understand the numbers, the math behind a rental property, it'll make you become a more confident real estate investor. Okay. And regardless of the market, regardless of what's going on in the economy, yes, in any period of your lifetime, throughout the past 100-year of real estate cycle, if you will, short-term volatility, is real estate is cyclical. But if you own a rental property over time, in any typical 10-year time frame, that you're always going to make money. That's how resilient owning real estate is, right? So, over the past 100 years, there's only one period where the real estate value has gone down, which is the 2008 financial crisis, right? The housing crash. Other than that, and maybe the 1929 depression, okay? None of us was born back in those times. Maybe some of us are age 100 and over. You may have experienced that as a young child, 1929 depression. Other than that, real estate have provided so much wealth building for the majority of Americans, those people who take action and who take a long-term approach and don't worry about the short-term volatility. I'm going to prove it to you, by the way, when I do the hypothetical calculation on this software, it'll show you that regardless, if you find a good deal, right? Today is a great deal because today is a buyer's market. If you know what I mean by buyer's market, you have less competition. The buyers have the negotiation power. The buyer have the upper hand. You can negotiate for deals. Look, there are 20,000 cities in the country. There are 6,000 counties. As a real estate investor, there's some neck of the wood, there's some zip code, there's some neighborhood where you find some great deals. This kind of deals, buyers intensive, the whole 9 yards. So don't let the short-term volatility or the doom and gloom or the negativity or the negative misleading data, the housing crash bros out there, the world's coming to an end, the doom and gloom scenarios. I mean, it's scary. Yeah, I know it's scaring a lot of people away. There are more real estate investors these days of sitting on the sidelines, waiting for the perfect storm before they take action. That's wrong. You cannot time the market, right? You buy real estate and wait instead of wait to buy real estate. So once again, especially for rookie investors and many savvy investors, so-called savvy investors that have one or more rental properties, you guys have continued to sit on the sidelines because, oh, what if there's a crash? What if this and that? Okay, I'm not gonna go over the economic situation. I'm just gonna run this scenario for you to let you know the high rate of return that you're getting, even if the market is down, even if you lose value on paper, that at least on your real estate asset, you can still make a very high overall return, which is higher than all the other asset classes out there, stocks and bonds and crypto and Bitcoin, whatever scenarios. Okay, so without further ado, I'm sorry for this long-winded explanation. Again, there's never a wrong time to buy real estate, okay? Because if your property cash flow, right, over time, at any given time, and you have a long-term perspective, if your investment retirement horizon is 5, 10, 15, 20 years away, who care if on paper the value of your rental property decrease, 3, 4, 5% at any given time? You are in it for the long haul, right? As long as you're receiving cash flow, as long as you're getting tax benefits, as long as you're getting your tenants to pay down your debts, and all that. I mean, stay the course, okay? Show discipline, commit to the long-term goal, don't panic, invest over time, and you will be rewarded, right? With that said, I know I got so much to cover. All right, this is a sample of a property. I could use any cash flow properties out there, but I decided to use this co-living property that we've been promoting within my network. This is a single family home, 7 bedroom, 7 bath, co-living, right? Co-living, rent by the room investment model, which is skyrocketing in growth, and a lot of our investors are doing so well. But I'm going to use this as an example. I'm going to run a lot of scenarios for you. You're going to walk away within the next 20 minutes, blown away by tremendous education, and you could become a much, much better investor. And not only that, you can get off the sidelines. If you've been sitting on the sidelines too long, waiting for the perfect time to get into real estate, there's a wrong mindset to have. But it's always stay invested in real estate, right? Buy at least one rental consistently, invest for a long term. But anyway, because this property is a 7 bedroom, 7 bath, is selling for at least today 325K. This is a real example, by the way. I'm using propertytracker.com. You can get a free account, propertytracker.com. You can get a free account unless you want to pay a monthly subscription, which I've been paying, like how much I've been paying? $37 a month, because I have a large portfolio to monitor using this software. But this is a great software. I've been using this software for 15 years, maybe even longer, and it has been sold to different owner from time to time. But the software and this analytics in this software allow me to manage my portfolio long distance. I live in San Francisco Bay Area, but a lot of my rentals, a lot of my investors' rental properties are located very long distance away. Is with professional property management, the whole 9 yards, turnkey, hands-off investment. You don't need a second job. But anyway, subscribe and like my YouTube channel as well. All right. And also put your email on my website so you can become a free member of our real estate network. And in your email inbox, you will receive free contents every week. All right. Several times to learn more about real estate investing, housing market, the whole 9 yards. All right. This property, 325K, you put 20% down payment, which is $70,000. That's fine. Closing costs. And this, because this is a co-living property, you have to provide furnitures and everything else for those workforce tenant and all that, which is additional $15,000 out of pocket to furnish everything, internet, utilities, the bedding, table, refrigerator, all everything else. And each of the 7 bedroom rent for $1,000 per month. So you have a amazing, this is an amazing investment model. So you have a monthly gross rent of $7,000, right? If all 7 member tenants are occupied by whatever. So I'm gonna share with you. Then if you put 20% down payment, we have a builder, which is amazing, an amazing builder incentive where you can get a 30-year fixed rate loan, DSCR, debt service coverage ratio loan, no doc, no W-2 required, no tax returns, and the property qualified for the loan, right? The underwriter, the loan, anyway, you can qualify for a very 5.5% with my seller, with my builder team partner that we have, 5.5% 30-year fixed rate, which is amazing for investment loan, even for no doc DSCR loan. Very, very popular loan. You can do more research about it. So at the end of the day, we calculate, your monthly taxes, insurance, property management fee, the whole 9 yards. At the end of the day, with only 20, you can do 20 to 25% down payment, but I put 20% down payment. Still, it's not cheap. You're out of pocket. Your down payment, closing costs, plus the furniture package, 15 grand to furnish all 7 rooms. Let's say 91,000 total out of pocket. All right. Of course, you need to you need to qualify with a good credit score, 700 or above. You have the 20 to 25% down payment available, and then the loan requirements as well that require you to have 6 months of PITI, principal taxes in insurance, principal interest taxes insurance, PITI of $13,000 cash reserve to qualify for this investment loan. All right, so this software even calculates how much cost per bedroom, right? There are 7 rooms, right? Based on the square footage of this house, which is 2,000 square foot. So you cost per square foot, cost per bedroom in this co-living model is $46,000. If cost per bedroom is $46,429, and you rent the room for $1,000 typically, guess what? Your rent to value ratio is 2.15%. The benchmark rent to value ratio, the 1% rule. And this co-living model exceed 1% rule and then some, which is 2.15% rule. Wow, amazing. At the end of the day, you minus all your maintenance, we factor in 5% appreciation projection, inflation rate of 3%, vacancy rate 5%, 8% for the co-living property management, and 8% for past split, who are gonna do all the marketing for us to get the workforce, working class tenant into your room. So 8% plus 8% is 16% from the gross rent. Maintenance percentage is 3%. So pretty realistic, right? And even with that, even with this monthly property management fee, insurance, property taxes, maintenance, and utilities, you have to pay for the utilities, your internet, your electric and gas and the whole 9 yards, another 1,100. So your operating expenses in around 3,000. At the end of the day, plus you pay such a reduced mortgage. Your mortgage rate, let's see how much is your mortgage rate right here, which is 14.53, right? Okay, your loan is 256,000, right? 30-year fixed, 5.5% rate, which is a builder special rate buy down you're not going to get anywhere else. Right? So therefore, your mortgage payment, as you see right here, is 1454 minus then your operating income 3500 operating income. How do you determine? See, this software calculate the operating income, uh, which is operating income is all property expenses, taxes, insurance, and everything else minus that's your operating income, all right, which is in this case 3500. Okay, and minus your mortgage monthly equals monthly net cash flow in excess of $2,000. I know, but if your mortgage rate is less, I mean, it's higher than 5.5%, then your cash flow will be a little bit less. I might show you the illustration a little bit later on. But then you get the benefit of another multi-dimension profit center, which is the principal paydown. There's an economic value associated with a principal paydown because your tenant is paying down the loan for you. So this is the annual benefit you get from the principal paydown, right? That's our economic return. And then something most of you have not heard is that inflation-induced debt destruction, which is the trademark of Jason Hartman, permission to use with attribution. I don't know what it means. I assume that as long as I mention his name, Jason Hartman, a real estate guru out there who kind of created this software, he created this inflation-induced debt destruction, which is you buying what. So it means right here, as inflation, read the fine print. As inflation happens, the real value of your loan balance goes down. So inflation debt destruction, IIDD, is a better metric. So it's another profit you can make on paper from your from your property. So 1 year appreciation is 16,000 based on 5% appreciation rate. Could be more, could be less. This is just an illustration, okay? Your projection inflation rate is 3%, the whole 9 yards. So at the end of the day, look at the very important metric you need to understand is that your capitalization rate is 13%. Most income property, long-term rentals, the capitalization rate is only like 5%. You have triple the capitalization rate. Capitalization rate, what does it mean? Look, here's the explanation. Capitalization rate is a quick way to compare similar properties. Say annual net operating income divided by the purchase price times 100. See, the formula is given to you. So annual net operating income, which is right here, 42,000, right? Divided by the purchase price, which is 325,000 multiplied by 100 equal 13%, 13.2% capitalization rate. This return, this yield is based on no leverage. It's based on you're not leveraging your money. You're not getting a loan, right? So that's how you compare one investment property to another. It's based on higher the capitalization rate, the higher return you're going to get in terms of cash flow and everything else, right? But this is a very important metric, cash on cash return. Some of you heard of it. What does it mean, cash on cash return? It means right here. Look at the formula. Very simple formula. Annual cash flow divided by cash invested multiplied by 100 equals your cash on cash return. Your annual net cash flow in this case scenario is 25,370, right? Your monthly net cash flow is a whopping $2,100, right? Annual 25,370. This annual net cash flow divided into your down payment of 91,000. So at the end of the first year, cash on cash return is 28% based on the formula right here, right? So 28% means 1/4, 1/4 of your down payment has been earned at the end of the first year because your annual net cash flow is a whopping 25 grand. You put down of 91,000. Simple math, right? According to this formula, it's a whopping 28% cash and cash return. This is extremely high from a real estate benchmark analysis. If you compare any kind of income property, whether it's a long-term rental, Airbnb, or mid-term rental type of asset class, you're going to be hard to find any cash or cash return at double digit. let alone 28%, right? And another final metric is the return on investment, ROI, at the end of the first year. Return on investment is a total return as a percent of what you invested. We also show version of the inflation debt uh, destruction. So at the bottom, gross equity income, cash flow plus principal paydown plus appreciation potential equal divided by cash invested multiplied by 100. Simple formula, right? So let's calculate. So the formula, the total ROI, which is very important. Okay, so then I'm gonna refute all the misconception that, oh, his cash flow is only $300 or $400. It's not a good return. Most people, they only look at one dimension of a rental property. Rental property have five dimensions, as I already discussed to you, right? So your annual net cash flow, let's crunch the numbers once again. Annual net cash flow 25,370, right? Plus the inflation-induced debt disruption, because you're getting a loan at today's dollar, and inflation debased the value of your loan with a cheaper future dollars. So based on Jason Hartman's uh, 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 author of this terminology, you're getting another monthly of $640 of reduction of economic benefit per month. Per year is 7680. So 7680 of inflation debt deduction plus principal pay down at the end of first year 3449, plus annual net cash flow with 25,370, plus your 1 year appreciation at 5% right here. This is my projection of 16,250, equals gross equity income 52,000 divided by your down payment, right? Your at risk of your investment 91,000 equals 58,000, 58% first year return. Imagine for the next 5 to 10 years, you will continue to own this property. Oh, by the way, I have not even discussed tax benefit. Oh my gosh, tax benefit. Like I know I'm not a tax advisor. You consider your tax advisor, but you can have a depreciation paper write-off. Some of you can get more, some of you can get less. It all depends, right? You can also incorporate, the cost segregation. I know some of this terminology may overwhelm you. Some of you can do 100% bonus depreciation. Some may have limitation in terms of an annual write-off, because real estate, according to the IRS, is a passive investment for paper tax purposes. So most of the investors, especially if you have high income levels, there's a limitation of how much passive losses depreciation you can deduct. But I'm not gonna get into too much. But it's safe to assume at the bare bone minimum, the depreciation, the paper write-off, and other deductions on your typical income property, you will get another few $1,000s of benefit other than the 58. So really, your total return at the end of the first year is really, if you including the tax benefit, is really around more than 58%. It could be like 60 to 70%. Okay, from your down payment. So you're leveraging the power of leverage. You only put in, in this case, 20% of your money, $90,000 property, to buy a asset at $325,000, right? And all the appreciation and tax benefit and rent, everything else have a form, a basis, form a foundation. You really, all your return is based on the value of the property when you bought it initially, not your down payment, right? So it's a power leverage. It's a OPM using other people's money. Okay, some of you are thinking, okay, so 58%, isn't this impressive, right? Who in your life, if you have a mentor, if you own at least one rental property, if you own no rental property, this video is important because it discusses all the high level, all the ways you can make money. Rental property is a multi-dimensional asset class, right? Even with short term, the volatility of the market, they may or may not affect your rental property depending on what you buy, right? Every real estate is local, each income property is local. If you can continue to get cash flow, right, over time, who cares about some so-called expert said the price of your property lost 5%. So what? It's on paper. It doesn't matter at this particular time because my investment is long term. I intend to hold my rental property 10, 15, 20 years, right? So you will make the money if you become a disciplined long-term investor. Okay, don't panic and everything. And yeah, you lose money if you sell, right? If you probably lose value on paper if you sell at the wrong time. Yeah, you may the cost of sale may allow you to lose money, maybe, right? But you're a long-term investor. So in fact, let me paint the scenario, and the scenario I'm going to paint to you that it pays to buy rental property. If you find a good deal, the cash flow, the returns will equal to the return I just provide you. So oh my gosh, this is so important. Let me share with you with something else. Let me go through some other scenarios with respect to this property. Let's say uh, uh, what other scenario I can paint. Uh, oh, okay. Let's say let's look at this evaluator. Let's change the scenario. Let's say 2026, your property uh, did not get any appreciation. Okay, instead of 5% projection rate appreciation, let's say 0%. So for this year at least, right, 0%. Okay, zero. How is going to affect your overall return? See, I'm painting you the worst case scenario. Okay, let me click submit. Even with no appreciation, right? You're still collecting cash flow, you're still collecting tax benefit, you're still collecting rent, the tenant is paying down your loan, whatever, right? You still can get all that benefit. So let's look at the first year performance. Okay, so as you can see, zero appreciation, right? Everything remains the same. All the profit center, the multidimensional aspect. Your return is 40% instead of 58%, right? Right here at the end of the first year. See, even your house lose value by a couple of percentage, your overall total ROI is still at 40%, including the inflation-induced debt destruction, this additional layer. Does it make sense? So you're still collecting cash flow. Okay. Okay, let me paint you another scenario. Let me give you another situation. What if your for some reason you do not qualify for this great builder rate buy down because only one of my builder that's selling the co-living properties have this amazing incentive. 5.5% 30-year fixed rate loan, investment loan at 5.5%. Ordinarily, as an investment loan, you pay higher than the owner occupied rate, let's say even 6.8 or 7%. So let's change it to 6.8% on another investment loan because you couldn't take advantage of using this particular builder that we're using. I have several builders that have different kind of co-living housing, new construction products, depending on what location you buy, right? So let's change to 6.8% instead of 5.8%, 30-year fixed, right? So let me click submit. And let me click 1-year projection. And so your loan payment is higher, right? Instead of 1,500, it's 1,695 because you're paying a higher mortgage rate, 6.8, which is the typical investment loan rate because the investment loan rate is higher than the owner occupier rate, and the owner occupier rate is probably around 6.4, 6.5% according to the mainstream news outlet Mortgage News Daily. And yet, yeah, your payment's higher, right? But your cash flow, instead of being how much, 2,200, it's come down to 1,873. All right, so maybe like how much is it? Around $500 monthly cash flow lower at 1,873. Is that a big concern? Not really. Most long-term rental, if you put 25% down payment on a 325K single family home and rents for 2,200, you only get like $300 monthly cash flow on a long-term rental, traditional rental. But on this co-living strategy, even with a 6.8% mortgage rate, 30-year fixed, you're still getting 1873 of monthly net cash flow, and your return on investment is not that much different. It's still around 38% total ROI at the end of the first year, right? I painted all kind of scenarios for you. So what if you're not okay? In fact, let me paint another not so rosy picture. Let's say the cash flow for whatever reason you're not getting $1,000 rent per room, for example. And let me go through another scenario. For example, let's paint the picture of a lower rent. Okay, let's say I'm not getting a $7,000. I'm not getting $1,000 rent per room. I'm getting, let's say, $900 rent per room times 7 rooms, so 900, or even 850. Okay, 850 per room rental. Maybe the rental market has softened, whatever. So let me do my calculation here. Uh, so instead of collecting $1,000 per room for the workforce tenant, I'm collecting 850. 850 multiplied by 7 equals $5,970. Okay, instead of collecting $7,000 rent, I'm collecting 5,950. 5,950. That's your monthly gross rent. Okay. Okay. In fact, vacancy. Let's paint a worst case scenario. Let's say instead of vacancy, typically 5%, let's say vacancy is 8%. I'm painting even 9%. Let's see, does it, because it's going to impact your ability to buy this kind of property, this co-living property, right? I've given you 4 case study on this software, the worst case scenario. Okay. All right. Okay. Okay. I'm going to submit. Now, now let's look at the 1 year performance return. Here we go. Here we go. The worst case scenario, no appreciation. The rent has reduced by around $150 per month per rent per workforce tenant out there. And what else? And the mortgage rate has increased from 5.5% to 6.8%. Okay, now let's look at the overall return. Okay, the overall return is did I do this right? Uh, oh no, I did something wrong. Okay, I input something incorrectly. So what did I input wrong? Oh, monthly. Oh, I'm sorry. Monthly gross rent is 5,950. 5,950. Okay, I put a wrong decimal. Okay, right? Back to 5,950 gross monthly rent. 9% vacancy rate. Let's say the maintenance percentage instead of 3%, let's say 6%. I'm giving you even a worst case scenario and no appreciation, hopefully at least short term, right? Okay, so let's submit again and let's look at the 1 year projection. Okay, we got it right. The worst case scenario, which is not likely to happen, right? In Jacksonville, Florida, our co-living markets are located in great areas in Jacksonville, in Tampa, Florida, in Orlando, Florida, in Ocala, Central Florida, and on Houston, Texas. And our co-living new construction model, rent by the room, 1 bedroom to 1 bath, which is iconic. There are 50,000 co-living rental properties located across 40 different markets. And most of those homes are renovated homes. They are older homes. They have like a 8 bedroom to 3 bath ratio or 10 bedroom to 3 bath ratio. So you have 3 or 4 member tenants sharing one bathroom. Those not ideal. With a brand new construction, ground up, specific for co-living, 1 bedroom to 1 bath ratio, you're collecting 20% more rent than a ordinarily traditional long co-living property somewhere else, right? So you get the renter to stay much longer, and they are happier the tenants with a one bedroom to one bathroom ratio. But that's why we have the best type of co-living properties anywhere out there in the country. So you stumble into a good turnkey provider, us, the Yi Real Estate Network. All right. So at the end of the day, as I conclude this, look at the worst case scenario, which I already show you the metrics. You're still getting a 22% return of your investment at the end of the first year. Still higher than the stock market rate of 6% or mutual funds, whatever, or bonds or money market. If you do an apple to apple comparison, still better because it's multi-dimensional, right? And you still get it, even with a much lower rent, you still get a rent to value ratio of 1.83%. You still qualify to get a DSCR loan because the DSCR loan, the rent to price ratio is 1%. This is almost 2% rent to value ratio. See the debt coverage ratio, 1.41. You still qualify to get a investment loan to buy a co-living property, right? Even though, again, uh, uh, cash on cash return is still 9%, it's still higher than a traditional rental. Let me see what else. Yeah, I have painted you the worst case scenario, higher mortgage rate, and you still cash flow $688 even with my projection is much lower rent. Instead of $7,000 rent, you're charging a little bit less than 6,000 on a monthly basis gross rent, and the vacancy is uh, a lot higher, right? See, the vacancy rate is 9%, which is not going to happen. Maintenance percentage is 6%, not likely because this is a brand new house with a warranties, right? 1 year warranty and a long-term 10-year warranty covering, a lot of stuff. So what a value to buy a new construction in a turnkey approach, one-stop shop that we have here. So let me see, did I cover everything? I mean, this video have taken longer than usual because it's so powerful, right? I mean, that's why you guys need to stay off the sideline and take action if you have the down payment. Not everybody have, $80 to $90,000 down payment to buy this type of co-living properties, but a lot of you have the money. We have some buyers already that are having some very good experience in this past year, so they are killing it. All right, so yep, cash is still cash flow under the worst case scenario, no appreciation on this projection. Still, you're still getting a cap rate of 8.8%, 9% cash on cash return, 22% return of your first year's investment performance, still cash flow almost $700. Anyway, so you know what? I think I rest my case. I paint you a realistic picture of the performance of the co-living property, which is the fastest growing asset class in the country, co-living, especially new construction, one bedroom, one bath. So anyway, so that's it. That's what I have to say. So my takeaway is uh, buy real estate and wait instead of wait to buy real estate. If you qualify, if you have the capital, if you have the credit score, if you have the motivation, if your goals and objectives on real estate is aligned with the kind of investment model that we're promoting, and I've given you a realistic scenario of very, very high numerical returns in terms of a cap rate, rent to value ratio, cash on cash return, total ROI, inflation-induced debt deduction, the tenant pay down your loan for you, increasing rent, increasing appreciation over time, turnkey property management, past split, doing all the marketing for you, and our co-living property management is doing all the day-to-day operations for you. Regardless of where you live in the country, you can buy out long distance property, hands off, and time freedom. You delegate everything. You delegate everything to a PassBit as a marketing technology platform. You delegate the co-living property manager to all the day-to-day hassle and everything else, so you can have a stress-free life, no headaches, no tenants and toilets. You can have time freedom to focus on what is important to you, so you're not no need to deal with a second job. even if you own 2 or 3 or 4 rentals of these co-living rentals, still pretty much passive, believe it or not. Okay, so isn't amazing? Uh, well, so if you see value from this presentation, please like and subscribe to my YouTube channel, and better yet, put your email on my email inbox on my website so you can become a free member of our real estate community of like-minded investors, so you can learn more about co-living and other traditional long-term investment, new construction, cash flow properties we have in other markets: Florida, Texas, Oklahoma, Alabama, and Buffalo, Niagara Falls, so forth and so on. All right. So anything that I didn't cover? So yeah, I have uh, I'm giving you a transparency. Okay, when you invest in real estate, this risk, but we have mitigate all the risk. We've been doing it for so long, right? We know the market, we know the neighborhood, we have done all the vetted. We have vetted the local neighborhood, we have vetted the markets. As I mentioned, our builder and us, we work as a one-stop shop approach. We have all the lenders, property managers, title companies, everything, at your disposal. So part of our network, you get the great resources. We have a system, process, and procedures to make your investment to be successful long term. That is okay. Thank you so much. This is SeeWing Yi for University Network. My contact information below. You can feel free to contact me. We can do a complimentary consultation. I do coaching, consulting, the whole 9 yards. We have a large community of real estate investors that we have cultivated for the past more than 2 decades here with the Year Real Estate Network. Sorry for this long-winded video. I have so much to share, so much. My brain is bursting with knowledge and education. I want to share with you out there. It dispels all the negativity around real estate investing, all the doom and gloom scenarios out there, which is crazy. You buy real estate and wait instead of wait to buy real estate. Get off the sideline. Okay, you need to participate in the game of real estate investing, because each day you're not earning the multi-dimension aspect of owning a rental property, which could be like 58% total ROI. Each day you're not investing, by sitting on the sidelines, you're losing cash flow. You're losing tax benefit. You're losing the tenants paying down your mortgage for you, so you have more equity. You're losing appreciation potential, all this equity gain you could have if you did not stay on the sidelines. So the best time to invest in real estate was 10 years ago. The second best time to invest in real estate was yesterday. All right. All right. Thank you so much for watching and listening. This is SeeWing Yi from the Year Real Estate Network. And take this information you learn from this video as a library, as a great resource. You can become a risk investor, very, very successful, very courageous, very fearless, as long as you know how to crunch the numbers. Okay. I know I use property tracker software, but there are other softwares out there that can show the similar returns. Run the numbers, use different scenarios, right? Use realistic numbers. Okay. Like I said, I'm being open-minded of you guys out there, and I'm being very transparent, right? I mean, I'm telling you all the pros and cons, but those people who are successful, they take action, okay? They overcome fear. They're a confident investor. The things you learn, all the projections, all the number crunching you just learn is empowering, okay? Nobody have taught you this kind of number scenarios, the returns, the numerical metrics I just shared with you. Okay, consider yourself very blessed and very lucky, because there's no other real estate gurus that spend the time to break it down to the nitty gritty of there's so many ways you can become wealthy in real estate. Not all about cash flow. Cash flow is just the foundation. All the other multi-dimensional aspect of owning rental property, that's the key to financial independence. All right, thank you so much. Have a nice day. Bye-bye. See you next time.